Hello, Roy, and thank you very much for joining us today.
Thank you very much. Good morning.
Perhaps if we can just kick things off with introducing yourself and, of course, Traiana.
Yeah. So, Roy Saadon, one of the founders of the company, a company that we started 10 years ago. My job right now is to build up and extend the EMEA business, which I run and operate. And previous to that, I was 9 years in the New York office, which was where our headquarters are. Traiana is a post-trade company that focuses on a cross-asset servicing. And our goal and focus is automating post-trade activities across multiple assets, focusing on reducing transaction costs and enabling additional flow to come into markets, focusing on real-time risk management, and automating a lot of the processes that are inherently manual that lead these markets to be T+1, T+2, make them a real-time market for the purpose of confirmations, risk management, etc.
So in your panel at TradeTech later in the year, you're going to be discussing innovative approaches to transaction cost analysis throughout the trading process. As a specialist in post-trade, what are the big innovations that you're seeing and perhaps championing as well?
So we're seeing a lot of improvement and sophistication in the way people trade. We see a lot of changes in the venues that are available, and now with new regulation, the way things can be cleared. That means there's a lot more options to the trader, but a lot more complexity as to where is my trade going to end up? How is my trade going to be cleared? What is the cost of that? Is there a different way of costing depending on the different venue that I choose? And all that has to be impacted to an algorithmic trading activity or to even a human decision. What we're trying to do through automation is make it seamless, make the checkout process to be part of the automated cycle of the day, but also make it so transparent so people know exactly what are the impacts of choosing one venue versus the other. So even though there is a proliferation of trading and clearing venues, we try to bring everything back into a central activity as far as knowing where my trade is, what do I have to do with it, how my trade is progressing, and manage all the risk associated with those activities.
So how simplifiable, if that's a word, is it to do that? Because surely, on the one hand, obviously you want to make it as easy as possible to say, right, I want to trade this at such and such a time in such and such a way. Here's my strategy. Make the best decisions you can in terms of a piece of software. But how do you also then balance that out with giving people the control they need to make the changes that they'll want to make?
So I promised to myself I won't use the word cloud computing, but for lack of a better term, what we have done is developed an environment which is a central environment that all the relevant activities and participants are connected to. So we have executing brokers, clearing and prime brokers, buy side, and then you have all the service providers such as the exchanges, the ECNs, the clearing venues, the CCPs, and we hook into every single one of those participants in order to provide information as part of the STP and consume information and statuses. What Traiana has done uniquely is rather than force a standard on everyone and say you all have to operate in a standard way and therefore you can join the network, is we normalize the data. We understand that there's a lot of legacy systems, a lot of legacy processes in place, a lot of new innovations that don't even have a standard defined. So we allow them to communicate as part of the trade life cycle. But by the time the data is in the system, we've normalized it. So a trader who's trading a synthetic transaction or a cash transaction and is using one MTF or one of the older exchanges and choosing between a plethora of CCPs, everything at the end of the day is brought back into a central activity. And the trade support group can know exactly where my trade is, how has it been executed, what activities do I have, what breaks do I have, and roll it back into a single environment that gives that visibility. And that is true for multiple assets, for FX, for futures, for equities, etc.
So, I mean, that must have been an enormous project. What were the biggest normalization challenges?
Funnily enough, we came into this market assuming that fix as a standard is going to be prolific in the post-trade as much as it is in the pre-trade. And our attempts were more on consuming the data. It turned out over time that the predominance of fix or FPML or any of the standards really falls short very quickly once you go post the activity. So a lot of our exercise has been about onboarding the activity and allowing and building technology that allows people to participate in this exercise, whether they're a real-time fix engine, whether they're a batch process with CSVs that come in every half hour, whether they're an end-of-day recap, and adjusting to all these functionalities. The second thing that we had to invest over time is the different trading paradigms, the entrance of algos as a cross-asset phenomena, the break of the concept of what a trade is versus what executions, the relationship between many fields in a single order and then many fund allocations. So we have a very robust data model that understands what a client is, what a fund is, what an investor is, but at the same time knows to relate it back to what a clearer is, what a prime broker, what an executing broker is, and collect and connect all these activities together. It's work in progress, it never stops, but doing it for 10 years, you really build a lot of really good, strong, powerful tools to help do that.
Now, these new regulations that are all due to come in and are indeed in progress, like MiFID, like Dodd-Frank, all these things that are happening, they're obviously going to bring in some level of standardization, and surely that must be something that's quite good for you. But is that actually how it's turning out to be?
No, in fact, we see the opposite. We see those regulations changing the way people interact and defining new processes, but not defining standards. What ends up happening is almost every single node to those participants, anyone who has to touch a trade at some stage, because of lack of standardization, because the regulation take a long time and no one wants to wait to be out there with a product, they start adopting a solution. It's often solutions based on assumptions, and not everyone shares the assumptions. So you end up with new processes where a trade has to go from the OTC market to the CCP market, but every CCP has got its own API, its own gateway, its own way of reporting. What we've done is, again, with those challenges, bringing it back to normalize, I think we're adding even more significant value, because my trade today, unheard of a few years ago, a single order can be executed on multiple MTFs and be traded one leg at a CCP while my executing broker may go to a different one, and allow interoperability to link. So if I have to figure out where my trade is, and is my trade good, and what is the cost of clearing that trade, I have so many data points I have to touch and collect. I think the problem is being compounded. So the idea of creating more visibility is one thing. How do you get that data once visibility has been defined by the regulators is quite complicated. And it's something that not any single bank or any single buy side really want to handle themselves. They want to go out there and say, someone collect, normalize, match, address, tell me what my breaks are, and if everything's good, tell me that I'm done.
Yeah, because that seems like that was the thinking behind the idea of a consolidated tape, which now seems to not be happening at all. It seems like they're going, well, we want to consolidate it, we just don't want to do the work, so we'll get private companies to do it. And that's going to end up making it actually far less consolidated than it already is. It seems like it's more like companies like yours that are bringing the data together and making it into a single package that a trader can make more sense of.
We definitely see a commercial opportunity that drove us into the space, but I have to say that the opportunity that we saw was not creating a reporting hub for the regulators. It was actually seeing the impact on transaction cost and the loss of trailing volumes because of transaction cost. And part of it is due to the fact that so many human resources and so much hand power has to go into now processing trades. We're bringing back some normalization and some normality to this marketplace by keeping transaction costs down, actually lowering it dramatically to what it was even before the regulation caused the changes in the market, and allowing flow that was on the verges of electronic flow, high frequency flow that was on the verges of, is this market relevant for us, to make it very relevant and introducing new activities in there. So we see a commercial benefit. We think the regulators will enjoy the side effect of all the normalization that we do, but really we're driven by servicing sell side and buy side, and anything that's a side effect of that is fantastic.
Of course, so what are the most common pitfalls then that people seem to be falling into in terms of their transaction costs?
The pitfalls that we see happening is there's a lure and an attempt to get to the best price. And the best price today can be driven from multiple venues. We have different venues: internalization networks, ECNs, off-exchange trading, synthetic options, and the regular exchanges. But people often discount how the impact of breaking a trade to smaller components to get the best price impacts the actual cost at the other end of it, cost of clearing. And where's the break-even point of figuring out, how do I do that? How much does it cost me to do that? So we're bringing a lot of that back by providing the automation and making it break the trade, collect it all back, and make it through an execution or electronic platform, so all that is seamless. And the second thing is provide very clear visibility into where my trade is, which venue did it go through, and provide information for anyone who's doing a TCA analysis to figure out how much this transaction actually cost me. So it's visibility, but also the automation to allow it to be a non-human activity, to only focus on breaks, not focus on, I've got a trade that's broken into 50 components with 10 different places. I've got to bring it all back together. It's a lot of manual power if you don't have an electronic way of doing it.
And of course, one of the benefits of trying to reduce your transaction costs, of course, it's going to help reduce your operational risk.
Yes.
How has that risk mitigation landscape changed in recent times, and how are you seeing it develop over or how do you envisage it developing over the next few years?
Yeah, we're very firm believers that even though all the markets at the end of the day are different, there is no reason why they should not all be T+0 from a risk management and a finality of trade aspect. We started in the world of FX, which was essentially a T+2 market. Today you can trade, give up, so trade away, give up to a prime broker, involve a clearing corporation, and be done with your trade within 5 minutes. No sure finality that the trade is done, non-disputed. When we enter the world of futures, the world of equities, there's still predominantly T+1, T+2 markets with regards to removing risk away. So one aspect is bringing the entire market to a T+0 activity. The second piece of it is providing what we call real-time risk management or on-trade risk management. And this is the control for all the aspect of high-frequency trading. People want the EMEA, people want to remove as many hurdles as possible on the way to trading, which removes a lot of the risk mitigation from that activity. But still, the post-trade world is still a end of day or intervals of day risk management, risk checking that has to be done in a real-time fashion. So we're bringing a complete, and especially when you trade in multiple venues, who knows my real position to manage my risk? So this real-time activity helps also bring a real-time nature of risk management, plus the concept of kill switches or the automated termination of activity based on what the risk is. So the operational risk really starts to cross over with real-time market risk and counterparty risk, but it's all the same tools to manage all three.
Do you think we're going to get to a point then where it's unheard of anymore to have end of day?
I think you can always strive to get to real-time risk management, especially for buy side who introduce a certain type of risk into the market. I do think this market evolves. So as we mitigate the risk in one way, the market evolves into a different way of trading. We're already seeing new challenges of looking at OTC versus listed trading side by side, which produces another type of challenge. But I definitely think that we are on the road and already have the ability in certain markets to see real time where my strategy is, what is my trading appetite, and how my electronic strategy is behaving compared to that appetite. And if there's any anomaly, any flash crash scenario, any activity that needs real-time monitoring in a complicated scenario to know that I'm, for some electronic or technical or code bug, I'm trading off that pattern and I'm off the territory, bring you back and do that. So that can be done already in certain assets.
Now, we were talking about transparency that the regulations are going to be demanding. Will this increased regulation and this transparency in clearing enable us to build the foundations to prevent the next financial crisis? Because to some degree that's what they're trying to achieve, rather than necessarily create more freedom of trading.
Yeah, it's almost like the unavoidable question, and the answer is always going to be a complicated one. I think there's a difference between what the regulation try to achieve and how it's being achieved. When the regulation, especially in the US, set off to try and mitigate risk and provide more transparency, and they ended up about fair access to market and bringing activity into CEFs and what is the purpose of a CEF and fair price discovery. Well, regulation has become a much bigger beast, and then there's a question of how do you manage that. And already we see firms exploiting the new regulation and finding a lot of niches and pitfalls in the regulation and saying, well, I can actually exploit the way this is done. So does it eliminate the chances of a new crisis? Probably not, because the market always evolves. What I hope it's going to do is make it more transparent that we're going into a problem, and make it more transparent, or make it more of a real-time intraday activity than an end-of-day activity. But basically, we're moving risk from one place to the other. We're moving risk into CCPs. Now you can say, look at MF Global. Did the CCP serve its cause? Was there money lost as a result of that activity? What if MF Global were a bigger firm? How would that impact? I mean, the jury's definitely out with regards to, are CCPs the end-all be-all solution? I always believe that when you find the end-all be-all, you're basically just not understanding how the market behaves, and they're going to introduce a new risk. So there's always going to be an evolution, and now the CCPs are going to be, what happens if a CCP fails? What happens if two CCP fails? How does that impact the activity? So I don't necessarily think that regulation will eliminate that, but you're definitely eliminating, regulation for me is eliminating the old problems so they don't happen again. So we're trying to make sure that the OTC lack of transparency goes away with more transparency. Will it eliminate the next break? Probably not, but let's make sure that we don't do the same mistakes again. The side effect of that is that the regulation is making the market a lot more complicated. And there are different recourses that come as a result of that. Again, as a firm, we specialize in trying to break down those complexities and bring everything back together. So there are opportunities for new firms, but there are definitely challenges with regards to market complexity and costs that are associated with the regulation. It's not just a free change that everyone adopts and everything is perfect and now no problems exist anymore.
To say no problems would exist would say that trading will never change again, and that's clearly not going to be the case. Do you think that means that then the regulators are always going to be a step behind the traders?
I think by definition. I don't expect them to be a step ahead. I think it's almost an unfair expertise or unfair expectation to have of them. What I don't want them to do is like a pendulum swing, see something happen bad in the past and rather focus on the problem. They're going to say we're going to completely reconfigure the whole landscape and solve problems that never really existed and create brand new problems as a result of it, rather than focusing on solving a specific problem that happened. And I think we do experience a certain pendulum swing in that the regulation is focused on so many more things. It's almost defocused because it's changing every aspect of trading, of clearing, of transparency, of fairness to the retail trader. What access to the price does he get? I wish we didn't experience that expense of a cost that we all have to bear. But I do think by definition regulators are always going to be a step behind.
And I think with those regulators, a lot of the commentators that I've been reading from, particularly with regards to MiFID II, have been saying that they're basically taking the MiFID I model that was designed for equities, and they're trying to apply it broad brush to all markets, and actually as a result are kind of getting it wrong. And there's from what I've read, there's quite some concerns over the direction that the regulations might be going actually won't regulate what needs to be taken care of, because they're just going, well, if it worked in equities, then it's going to work in all other asset classes.
Yeah. You can say the same thing in the US about CFTC and the futures market. We're trying to take OTC markets and force them into the futures mold and say you got to be clearing in a similar way. I actually believe that at the end of the day, you want to trade, you want to affirm your trade, you want to allocate it if you have managing multiple accounts. You want to be able to have multiple clearers for the purpose of reducing the concentration risk that now the buy side see against the sell side. And you want to have cheap clearing and trading. That is true across all assets. I do think it creates very common building blocks across them. But as we moved our expertise from FX to futures to equities, there's so much legacy activities. There's a difference between a market that's open 24 hours around the globe and a market that's open from bespoke and separate exchanges, like in equities that you can trade fungible products, and you go to futures and they're non-fungible at all because they're patent protected. So there are differences, but if you distill it, you do want to have a safe market. I hope that the regulators will focus on goals rather than how. If you get away from the how-to and allow people to develop expertise, you can't set goals that are cross-asset. When they get too involved in describing how it should be done and say everything has to behave the same, that's what concerns me. I'd much rather they focus on risk mitigation through clearing is good. I'll let you figure out how you do that.
Now, I know you were saying to me this morning that equities is relatively new space for Traiana.
Yeah.
What is it that drew you to that, and how have you seen it change over the last couple of years?
Well, what drew us is two big aspects. Our client base attracted us to that, both the buy side and the sell side. And the nature of a flow market that is still got a lot of end of day T+1, T+2 processes. And we know that these markets should all be a T0 market. So the clients have said, what you've done in FX or the FX is a much more streamlined process than a centrally regulated environment like equities and futures. Bring that activity over there. What made it also interesting for us is we acquired the largest synthetic equity network that mimics the cash world and does it in a much more efficient fashion than cash. So we already had a footprint of an existing multi-broker, multi-clearer network, and adding to that our expertise in other assets. We're now looking at the entire cash equity, the entire derivatives network. So in the equities world, we already managed to build a network of over 70 executing brokers, 13 prime brokers, and a plethora of buy side who are using the exact same philosophical approach they have in FX in the equities with different implementation, but the exact same approach. So we see, from our perspective, any flow market that is inefficient on a post-trade is automatically the next market we're going to be in, because that's exactly where we see the inefficiencies that we specialize in solving.
Well, thank you very much for speaking with us today, Roy, but unfortunately we are now out of time. Obviously you will be speaking at TradeTech in April, but if people want to find out a bit more about you before then, where can they go?
So the best place to go to is our website, Traiana.com. There are contact information to all our centers in Asia, New York, and London, and people are always welcome to contact me directly, roy@Traiana.com.
And of course, if you do want to see Roy live in the panel session, you can find out more information at TradeTechEurope.com.